Well, good morning, John. It's good to see you. We're recording this on Friday morning and quite a few things to discuss. Yesterday, we had an initial public offering of Gomez y Guzman y Gomez, the Mexican fast food company, and it went off with a real bang. John, this is the first big IPO we've had in a number of years, and is it significant that the market responded so positively to this? Is this a one-off, or do you think that this is going to result in a bit more confidence coming back into the IPO market? The issue price for the stock, just by way of reference, was $22 a share, came on at 30, which is a 36% premium. You got to think that's a very, very positive debut for the company. What do you think, John?
Well, I tip my hat off to the vendors, the entrepreneurs who are experienced corporate market, I almost say marketeers, and they've done the right thing. Assess value, they've let some stock go below assessed value. Now we can question the assessment of value. That's a different thing, but they restricted the amount of stock, created a liquidity squeeze and got the price up to where they wanted it. So by not being too greedy, you can say their value, because they control the company. So the revaluation, so it was restricted supply, excessive demand, and it gets a nice outcome for those who are lucky enough to get the stock, even though I think not many people got the stock relatively. But that's doesn't give you confidence in the market. Look, one argument is if you float a company at an appropriate price and leave something on the table for investors, then the market's there, And it goes back to my thematic about value and price. If vendors and capital raisers look after investors, then there's heaps of demand. But if you want to raise money or issue stock at excessive prices, there's not much demand. Now, obviously, we're going through a period through COVID, and then we had the bond market correction, and we're now coming out the other side. I think it does, to your point, Paul, confidence is going to return, and I'm quite confident about 2025. There's clearly a lot of tailwinds after we get through the election in Australia. There's quite a lot of tailwinds developing, so it is a sign of good things to come.
Yeah, although just lately we've had quite a bit of kind of weak outlook statements from retailers. I think this morning Mosaic Brands and the camping outfit Kathmandu have both said that demand for their products has been weak lately. How are you seeing? I know you're in touch with small companies, private businesses. Are you seeing a weak environment out there?
It is. It's quite weak in retail, and it defies the commentary by so many talking heads in the papers saying we need an interest rate increase to dampen down demand. Now, it is beyond belief that these people continue with that nonsense. Australia does not need an interest rate increase. It's very hard to bring interest rates down, as I keep on saying, for America sitting 1.25% above ours. So let's put that one to bed. The economy is just moving along, and really the growth we're seeing is population, immigration. Take that out, and the economy, with the people who were here 4 years ago, if that was just the assessment, the economy has stalled greatly and probably gone back, and particularly in that household sector with mortgages. Now, it is bleeding obvious, and these talking heads, I don't know what, rely on inane commentary from the central bank. The RBA keeps on trying, I don't know what their game is, but they keep on talking the economy down by saying, look, it's growing too quick, we need to put up interest rates. Well, look at your own numbers. So that's my comment on that. But we will get through this. There will be wage increases of some sort. There'll be tax cuts coming next week. We've got government assistance to low-income earners coming. It's an election year, so look out for some more giveaways coming into an election, Paul. Population growth compounding. The economy will be quite solid 25, 26, 27. Okay. And the market rightly is anticipating that, ignoring the nonsense going on in the commentary by economists who really, I don't know how they come up with their solutions. And the market, it's not going to power on, Paul. It's not going to power on, but it's just going to be nicely solid. And companies which are well positioned to benefit from population growth and not be hit by cost increases, the cost of doing business, will do well.
Yeah.
And that's unfortunate because there'll be the companies which the low employers will do well.
John, watching the news last night, and I'm sure a lot of our audience would have seen this as well, Choice Magazine has come out with the comparison of a shopping basket purchased at Coles, Woolies and Aldi, and obviously Coles and Woolies, the basket costs 67 or 68 bucks, and the Aldi basket costs something like 50 bucks, much, much lower. Is this, I mean, Coles and Woolies are both listed companies and I think, widely invested by the public. Aldi's a private German company. What do you think is the implications of the government focus on this duopoly? Do you think that it's a fair comparison, even though the service offerings are essentially quite different?
Well, that's exactly right. And look, it is going to create an issue for Coles and Woolies. I don't think we should duck and weave. I think it's pretty bland statement regarding shopping baskets. The difference is too large. So that's a warning shot. And we're looking at it in the investment team about the repercussions of this, because there will be more political interference in the grocery market. Now, I've got a lot of experience in the grocery market. Probably one of my biggest plays 30 years ago was in independent wholesalers and grocers. So I know a bit about this. And we've gone through a whole lot of cycles. And people just got to reflect that probably 20 years ago, Woolies and Coles started to go aggressively into no names, household brands, and cut down the supply of food suppliers in the offer. And that sort of backfired because for a whole lot of reasons, they didn't know how to promote it. There was some discussion about the quality, a black and white baked beans to a Heinz baked beans, and people sort of, whether they knew it or not, sort of came to the conclusion, no, the black and white's not as good as the Heinz. It could have been the same manufacturer. Yeah, it was completely debauched. Woolies and Coles now have a very broad offer, and that's what they say to their customers. Look, you have abundant choice on the shelf. Aldi says you have no choice on the shelf, but the benefit is lower cost. And on essential items, maybe Aldi has an unfair advantage. And we're seeing the market split where people who want their essentials go to Aldi, and people who want choice with a bit more money to spend go to Coles and Woolies. But my comment is I think that difference is too great, and I think there'll be political pressure for Coles and Woolies to bring down that difference. And then Coles and Woolies, the bad news is small food manufacturers who are getting a go at Coles and Woolies may be cut out. And so the politicians need to understand that. Coles and Woolies need to state it more clearly, and the food manufacturing industry of Australia needs to stand up and say what they expect from the retailers. If everyone gives a little, we can get a great result. But if we start cutting out small food retailers in Australia, there'll be consequences. So it is a very difficult issue, and I think price is one aspect of it, but there's a lot more going on in the food retail market.
Mm. Just switching topics, but staying with the domestic markets, I noticed that Dexus and Growth Point, so these are two REITs that specialize in office, in the office market. They've both had or indicating revaluations of their portfolios going down. In fact, when I was looking at Dexus, I think they've revalued something like 30 of their office properties and 11% downward revision in revalues. But they've been downwardly revaluing their properties now for, I think it's 4 or 5 quarters. And when you add it all up, it's close to 30%. So I think this is a consequence, a long-term consequence of the work from home trend, from vacancy increases in offices, and still perhaps the long-term consequences from the COVID lockdowns. But are office trusts now starting to be discounted too deeply? Some of these things are now on 20% discounts to NTA, even after the revals. Are they starting to become attractive now? Should we be looking at office REITs?
Well, they clearly are, because this is a cyclical market. Okay, so let's just put it in context. It's cyclical, and in terms of this devaluations going through, it's probably a year behind the weakness in the bond market, which valuers take their risk-free rate of return and do an assessment of fair market yield, and then they break up the market based on growth potential. Look at occupancy and vacancy rates. Now, one issue I have a concern about is I think a lot of these devaluations are occurring now in Sydney, because the commercial centre of Sydney has moved from the Stock Exchange area, or Martin Place, around that quadrant, has moved to Barangaroo. So you've created a vacuum. And then, as you say, the work from home. So I think that's what that commercial market in Sydney is taking a significant hit. And hopefully we're at the bottom, and that's it. But that commercial property has to be filled and then show to the valuers that there's an opportunity to grow rentals in the next 5 years, so to speak, at least match inflation. And that's still a discussion and investigation to be had. So having said that, premier commercial, well located in the vibrant places, say Barangaroo, for instance, in Sydney, I guess parts of Collins Street, Melbourne, and the major centres in Perth, West Perth and St George's Terrace. I mean, there'll be an assessment made, but I take your point. I think parts of the commercial market are probably now undervalued. Parts of it still have a work through, and the premier probably is, there's not much value there. But clearly, you're looking in the commercial market, there's places to avoid and places to look at. So I'd suggest Perth commercial market's probably coming back into play. I was over there 2 weeks ago, and it's been in the doldrums so long, you can clearly see activity appearing in Perth from immigration, recovering resources, and the in-out workers coming. And residential property looks quite cheap in terms of units. So my point is, to finalise the answer, is that we don't have to invest in commercial, but I think there's opportunity appearing. You've identified it. If the listed property market is oversold, then clearly we should look at it. If those yields are far superior to bond yields, which they look like they're now jumping to 3%, 3% above bond yields with potential growth through inflation, yes, there's an opportunity appearing. So that's that. I think absolutely agree, Paul.
Yeah, I just looked at Dexus's. So this is the historic dividend yields about 7.5%. So that's roughly 3% above the bond yields where it's at. So it's certainly worth having a closer look at.
And it's well above inflation, Paul. I mean, inflation's 3.5%, so you can take another 0.5%. So you're talking double the inflation rate with growth potential. Now, be careful. Anyone watching this video, be careful. Get some advice. Investigate.
Yeah. Last question, John. Overnight, the Swiss National Bank reduced interest rates. They were already on 1.5, went down to 1.25. Bank of England also had a look, and even though inflation in May was only 2%, perhaps with an election only 1 week out, they decided to stay unchanged, but they did indicate that the next move would be down. Just to remind the audience why the market is so focused on interest rates by central banks, we had a look at the last 100 years in the US market, and on average, after the Fed cuts rates for the first time, the market tends to go up around 10% in the 6 months following that, and 15% in the 12 months following that. So there's a great historical precedent for markets performing well in the wake of interest rate cuts. John, you still anticipating, even though that there's a lot of chatter at the RBA, that the next change in rates will be down, and when do you expect it to be?
Well, I think that we'll be cutting in the December quarter after America's cut in the September quarter. And America, the central bank over there, be just like the UK central bank's now in a quandary, but they got caught in the quandary because the election was called early. So the Central Bank of England doesn't want to get into a political debate, but the election was brought forward. They probably would be cutting, as you say, now. Now, the Central Bank of America knows when the election is, and if they don't bring it down shortly, they're going to be stuck through the election. Otherwise, they'll get into a partisan debate. So, and the Australian Central Bank is caught in a world of pain because they've let the housing market get out of control, and the leverage in the housing market is at historic highs, and the affordability is at historic lows. I mean, it's so badly managed, it's embarrassing. But the interesting thing is, I just want to get back to your point, which you made about the surge in equity markets after. I think that's the crucial issue. Now, these interest rate cuts are being so well telegraphed, and there's so much liquidity in the markets, and there's so much potential demand. It's almost like we know interest rates are going to get cut. Do we wait till they get cut, or do we go early? And I think that's what's happened, particularly in America and Germany, and particularly looking at markets very elevated, happening now in UK, where their markets come to life after being dead for 10 years. I mean, I think this time around, if history says 10%, I think we're already done most of it pre the cut.
Yeah,
so well telegraphed. So I don't expect a surge.
Yeah,
I think we've had a bit of the surge already. And the pullbacks we're seeing is only because of delays. You know what I mean? The market's pulling back and delaying. So I wouldn't get as excited about interest rate cuts around the world, but I would be a little bit more excited about Australia because our interest rates are fairly low historically. And I think the surge coming from immigration, the compound effect of that through the economy will be felt, continue to be felt for years ahead. So we've got a lot of momentum behind us. So I'm quite confident about the Australian market continuing to deliver that sort of 8% compound return, of which half is dividends, you know. So I think that's in, but I don't see a surge.
Okay. All right. Good to end there. John, thanks. Interesting as always. And
just by the way, Paul, I'm presenting in Sydney next week. If anyone watching this video in Sydney wants to come along, interstate people can fly in, but I think that's a bit hard. So Sydney presentation next week. Watch the website, and I think we'll have an invitation below this video for people who want to attend next Thursday in Sydney.
Terrific. Thank you very much, and we will see you next week. Thanks, John.
Thanks.